Coming up today, stocks finish lower on the back of hot inflation. Intel continues to rip. Robinhood soars in after hours. Meet Kevin shuts down his ETF. Geopolitical tensions getting dialed down. And where to from here? It's another big day, guys. Let's get it. And welcome back to Click Capital, where we focus on the signals, not the noise. Every day after market close, I break down all the latest market action and news, plus share some of my own trades with you guys. So if you haven't already, smash that subscribe button and jump on board with Click Capital today. And so once again, the main indices are a bit soft here. Did have a bit of a sizable gap down to start trading off this morning after inflation came in a little hotter than expected, but we've still got quite a checkered heat map here. Lots of spots of green and red, plenty of rotations going on out there, and we've still got heaps of hot stocks ripping up there today, which I'll get into later. But what's really got people talking today and markets moving is inflation. And does anybody remember a couple of months ago when Powell did that big jumbo 50 basis cut right in front of the election? And I said he's likely to flip after Trump gets in, because like I said back then, it was clear the risks were to the upside with inflation and the economy overheating versus downside risks in unemployment spiking and the economy contracting. And so just looking at the spider and how it traded this morning, like I said, pretty sizable gap down to start the day, but it was pretty much bought right off the bat. No points for guessing where the inflation report came out, but look at that, right off the open. Came down, had a little retest, not even at the midpoint of the first 5-minute candle, and was pretty much up and to the right for the rest of the day, even though we did still finish lower than yesterday's close. And small caps are still somewhat flat at the moment. We actually had the Nasdaq finish a touch higher, and then just looking at mid caps there, lost their 50-day VWAP. So still quite a bit of softness out there in the market. In fact, mid caps are still off highs by more than 7% here and trading below the day after the election in November. So even though we did see some dip buys off the open, market's still a little soft here. But one encouraging sign, the market was down and so was the VIX. Did have a little spike there in the morning, but overall still really subdued here in volatility markets, 15.8. But keep in mind this is based on the S&P 500 market cap weighted index, heavily influenced by mega cap tech. SIBO has actually just come out with a new index, S&P 500 Constituent Volatility Index, which is looking at a more equal weighted volatility of stocks in the index. And so like I've been noting of late, there's quite a gap between single stock volatility and market level volatility. But overall, the VIX term structure is still quite steep and contango. Option dealers on the whole are pretty chill here. Even the VIX 6-month is still under 20 here. And so talk of tariffs, DeepSeek, hotter inflation, whilst it's shaking markets in its initial reactions to the headlines, things are calming down in pretty quick order. Looking at bond market volatility here, still well off those highs from going into the election. And we did get a decent bump up in the 2-year yield there, 435. Same with the 10-year, 462, which I would have thought could have rattled the stock market a bit more than it did. At least volatility could have held on to some gains today. But it didn't, and we've still got bonds falling over. TLT just losing its 50-day VWAP. And I'll come back to inflation in a minute. But just looking at the options market, we got plenty of action going on. Like I said, underneath the surface, still plenty of stocks ripping out there. In fact, the top 25 most traded options, vast majority of these stocks are ripping up today. Tesla up the top as usual. Meta on its 18th consecutive day, finishing higher. It's an all-time record for the stock. Alibaba having another good day. I'll get into the charts on that later. Palantir still on a run. Intel having another good bump up, and we just got earnings from Robinhood, but even in regular trading, they were doing really well. Plenty of action in the options market here. And Robinhood's stock is absolutely ripping after hours as I speak on the back of their blowout quarter. Just reported earnings per share of $1.01 versus analyst forecast of 42 cents. Quarterly revenue hit $101 billion, up 115% year over year. That was coming in ahead of expectations as well. And they're continuing to roll out more product and more markets around the world, really aggressively expanding, along with 2.6 million customers joining their gold service. And so the business characteristics of app-based businesses are so good. They're so scalable. Look at the daily on Robinhood. Absolute tear pretty much the last year here. And just going down to a 5-minute chart after hours as I speak, slapping on another 16% today, currently trading at 64. Absolutely ripping up after hours here. And so that's telling us trading is well and alive. And just because we're breaking out to new records and retail trader participation doesn't mean the whole thing is going to topple over tomorrow. This can go on for years. And we are at a point with technology where it's just so easy to access the markets. We should be sitting at all-time high participation. People all over the world can easily access the US stock market, and Robinhood is expanding to help millions and millions of more consumers buy stocks right from their smartphones. And so everything for this stock is just pointing up. Even my seasonality forecast indicator nailed it coming into today. Super high readings of how the stock's performed in the past and this same calendar period going forward. And just a reminder, anybody who wants my seasonality forecast indicator for free, just click the link below this video and you can get it added to your TradingView account today as well. We also just got earnings come in from tech heavyweight Cisco, coming in with a little beat there, trading up pretty well after hours, 6% 6.8%. Obviously giving some good guidance. They're another company set to benefit from the AI infrastructure boom. And there's a look at Nvidia, still hovering around its 50-day VWAP, 131 a share. AMD still trying to form a base down here at 111. We just got news today. An insider just picked up $500,000 of shares recently as well. Good to see those on the board buying the dip. But what's really been waking up of late and is actually on a run not seen in more than 2 decades, Intel, America's prior chip leader. And on the back of JD Vance's comments at an AI summit in Europe, in which his administration's heavily focused on bringing chip production back to the States, Intel's going to be a core part of that. Having built new manufacturing facilities in Ohio and Arizona, I think they're going to have a really strong political tailwind for quite a few more years, actually. And just like AMD, CPUs will still very much be needed, not just for PCs, but also for data centers. Obviously, the GPUs are doing all the heavy lifting. However, CPUs still play an important part, especially after AI models have been trained. Then they go into inference, where CPUs come into play as well. And when the market changes its mind, it can do so swiftly, ripping up another 7.2% today on good volume. This is a nice thrust off these lows that have been forming for a few months now. And if we just draw a volume profile from that nasty gap down in August last year to where we are today, point of controls pretty much smack bang at $20 a share. And so the further we move away from that, the more the bulls are in control. Then obviously we've got a bit of a resistance zone around $25 a share. Luckily stocks can come and bump around before they take it out, maybe pull back, consolidate before potentially taking this out. So who knows, Intel may be trading in the 30s come Christmas. So we'll see how that one plays out. Also continuing to run hard again today, Alibaba ahead of their earnings. Later next week, another momentum thrust signal. Big volume just absolutely running here. And just like the late great Charlie Munger, who was really bullish on the company, and like I've always believed, I don't think he's wrong. I just think he was way too early. And this is a classic move for Chinese stocks. I've traded on the Hong Kong, Shanghai, and Shenzhen stock exchanges. And man, those stocks, can they move? Super hot momentum. And in fact, on the Chinese mainland, they actually limit stocks to either 10 or 20% daily moves. While the time stocks can just gap up 10, 20%. And just like we heard from David Tepper on CNBC yesterday, when he was asked about how does he think about tariffs in relation to placing over a third of his portfolio in Chinese stocks, he said he simply doesn't care. That's not why he's investing here. He loves the valuations. And so he's betting heavy on Chinese shares going forward. Another one I got, Tiger Brokers, also having a great day today, up 11.6% on pretty good volume here, pushing up on this resistance zone. And just like I told you guys after last earnings, when they came in with a really good quarter actually, over 100% above expectations, said pay attention to the numbers, not always the initial market reaction. And that's why I was adding to my position in the 5s. And again, when Chinese stocks move, they can do so with vigor, already up 55% off the bottom. But again, I believe we're just getting started here. Of course, we've still got some hurdles and risks. Hopefully the US-China trade war doesn't blow out, but even if it does escalate, we may get that initial spook and reaction on the headlines like we've been seeing. The market may just shrug it off. Appears to be a lot of activity coming back to Chinese shares, and that's great for Tiger Brokers as they offer kind of a two-way bridge in Chinese markets. You can trade Hong Kong and Chinese shares with them, and then they also offer Hong Kong, Singapore, and other countries in Asia Pacific and around the world access to the US markets as well. And they've also got some fund management products and a few other bits and pieces. So I continue to believe in this company, and I've been trading on their platform every day for a few months now, really liking it. Can comfortably say they've got one of the best out there. Also shaping up is Baidu. Heavy signs of accumulation here, as we can see on the chart with these fat green candles. And we do have earnings mid next week, and that's probably what's holding the stock back. Can't get carried away as the market's still cautious on earnings. However, I wouldn't be surprised if we get a pretty good gap up on Baidu next week. Catching up with his peers in the Chinese market, just looking at that price action in Alibaba. And they're also getting into AI chatbots in a big way as well. So we'll see how they do next week. Just moving over to Tesla, still sitting in this golden pocket that I've drawn on the chart here. And just to explain to those that don't know, that's a Fibonacci move from the low prior to last earnings to that swing high. Now, I know technically the golden pocket, some people say it's between 60, 65, 61.8 or whatever. It's just around that zone. A lot of the time you see markets, they can pull back 50% to 65%. So I've changed that box to a golden color to represent golden pocket. Sometimes you can get those deeper dips, but typically if a market takes out that 78% level, it can be an indication of a trend change or at least a consolidation. So if this uptrend were to really hold here, Tesla shares would have to find a little bit of a local low around these 330s, 320s, maybe down to 310. And my indicators are suggesting this move could be nearing exhaustion. But sometimes these big psychological levels act like a magnet. You can often see the stock trade down just above it or just through it, just like it did back up in mid-December. Got about 12 points shy of 500. Last time it bottomed in early 2023 was just above 100. And the market's kind of always traded like that. Big psychological levels, Institutions and other large funds, ETFs and that, they'll do their option strategies at big, large levels. That's why you'll always see a large amount of open interest at 330, 320, 310, 300, or what some people call call walls, put walls. Kind of irrelevant. There's always large open interest at pretty much every rounded number. But the tail doesn't wag the dog. Institutions are more trading the stock, along with retail investors as well, who actually only make up a small percentage of actual volume in the trading. They don't really move markets around too much. So in other words, everyone's looking at $300 a share. And like I said, sometimes it can bottom out just above it or just take it out. So we'll see what happens if we get down to that 3 handle over the coming days. But stick with me today because I'll come back to the charts later on. I'll show you some hot stocks out there and a few other interesting stocks catching a bid there today. But just circling back to the headline of the day, inflation. Market really didn't like it off the open. Like I said, we did get a few dip buys, but overall indices still finished down. A lot of stocks in the red. Not a complete bearish breadth of a sell-off of a day. We haven't seen one of those for a long time, actually. Still plenty of rotations. Hot stocks holding up. But what are we to make of all this? Well, like we've been saying of late, pretty much keeps the Fed in the same spot, caught in the middle. Honestly believe Jay Powell doesn't really know what his next move's going to be. And he might not make his move for months, up or down. Obviously, inflation is not getting back down to under 2% anytime soon, which shouldn't come as any real surprise anyway. Over a quarter of all US dollars created in the last 4 years. Government spending off the charts. That's not just all going to wash out overnight, including the actions he's taken at his time heading up the Fed, blowing out his own balance sheet, printing trillions and trillions of dollars of new money added to the system. Again, that's not just going to wash out overnight. But let's just get away from the headlines and rhetoric out there, and let's just look at the numbers. United States inflation rate, month-over-month increase, was definitely a touch on the hot side, 0.5%. We haven't seen that since August last year, and like the trend we've been seeing on a lot of inflation data, it's pretty much just kind of basing, holding on here. I haven't seen big breakouts on the upside in a lot of data points, and it's going back 10 years. It's not all that crazy, what we've seen in the past decade. Definitely that 21, 22 period was different, but just going out to max, going back all the way to the late 40s, you can see inflation waves, kind of clusters, high and low readings, similar to volatility. So we very well could see another upwave here. And there's a look at the year-over-year inflation rate, 3%. That's still somewhat basing as well, just going down to the 5 years there. Like I said, hasn't really broken out. We'd really need to take that 4 handle to really get things changing in the markets. And if the Fed hasn't already by then, they'll have to hike rates then. And just like the second half of 21, most stocks started rolling over when inflation really broke out. Fed had to jack rates and made 22 a down year. So for the here and now, it's definitely on watch. Like I've been saying, the risks are to the upside, but it can bump around here in the short term. And the fact is, a lot of these economic data prints, headlines we get are quite often lagging. I think a better read on inflation's Truflation, which actually ticked down again today. They look at millions of data points throughout the economy, real-time prices, and they've got inflation currently tracking at 2.07 and just going out to a max chart there, still well off highs, 11.59. That was actually well above government reported inflation back then. And as you can see, once again, it's kind of just basing, tracking sideways, bumping around, and didn't actually break out over the last year either. So if this thing started breaking out, taking out 3.1, 3.2, again, that could get markets nervous, and Jay Powell may indeed start turning hawkish again. Might have to backtrack his big dovish cut, like I said back then, he shouldn't have done in the first place. And we are already seeing isolated pockets of some products breaking out. Eggs, eggflation is back. Average price of a dozen grade A eggs in the States, currently around $5. And no doubt it's sparking nerves out there. The headlines of hot inflation, treasury yields bumping up, reports that the Fed may have gone too far in cutting rates. Ever since they did, bond yields just ripped higher. Then especially after Trump got in, on the market's expectation, US economy growth could hold up or accelerate, while we've seen a strong dollar as well. Not to mention, the Fed's been on pause for a while the rest of the world is continuing to cut, widening the interest rate differential between the States and the rest of the world. And even the big kahuna himself said today, we're not quite there, but will we actually get there this year, next year, anytime soon? Me personally, I think 3 is the new 2. He just doesn't want to acknowledge that because he's helped to contribute to it. But for the bears who like to trade off statistics, they do have a good point here. This is the year of the snake, looking at the 12 different Chinese zodiac signs. Looking back in history, from 1950, the S&P 500 was only higher 50% of the time in the year of the snake. Average return, 0.8%. Does get a bit better next year. 2026, the year of the horse, 6.3% average return. And the bulls should get excited because 2027 is going to be the year of the goat. And when that happens, the market's higher 83% of the time, 14.9% average gains. gains. Another bad statistic for the Bulls here. Whenever a Philadelphia sports team wins a World Series or Super Bowl, bad things happen in the market. Saw that with the Philadelphia Athletics, the old baseball team, the Phillies and the Eagles, and just recently, last weekend, Eagles smashed the Chiefs. Looking back in history, when that happens, we can get crashes, depressions, financial crises, or just stocks plain pulling back. But again, guys, this is just another statistic. Don't get too caught up in it. Correlation doesn't prove causation, because at one point in time, for a few years there, we had a pretty strong correlation between the number of people who drowned by falling into a pool and the number of films Nicolas Cage appeared in. Again, correlation doesn't prove causation. You torture data enough, it will confess something to you. But no doubt, on plenty of valuation measures, the S&P 500 index, that market cap weighted index, heavily skewed by just a handful of companies that everyone obsesses over, is definitely at peaks on a lot of measures, price to sales being one of them. For those of you who don't know, it's a simple valuation measure. For example, you got a restaurant doing $1 million a year in sales. If it sold for $8 million, that would be a price to sales of $8 million. Now, typically public companies trade at a heavy premium to private companies. However, private businesses take a bit more effort to operate or even overlook compared to pushing a button and owning a stock. But nonetheless, what you're looking at here in the orange line is the market cap weighted S&P 500 price to sales. They're same levels as the late 90s. In the blue line is the median price to sales. What's the average S&P 500 price to sales at a much more reasonable 3? And what you'll notice over the last 40 years, they've both actually been uptrending over time. As my regular viewers know, I've pointed out a few times that valuations are in big secular uptrends, even going back 150 years. You can see that by the dotted regression line showing the trends here. And so there's a secular uptrend in valuations for many reasons. And again, people will get caught up and even argue that this blue line is significantly overvalued because it's much higher than 20, 40, 50, 100 years ago or whatever. However, you got to remember, price is what you pay, value is what you get. And like I said, there's many reasons for the secular uptrend in valuations over time. One of them being companies have simply become much more profitable, much more efficient. That's thanks to technology. Much easier to scale a product around the world, along with hosting it on the cloud instead of physical inventory. And especially now going into automation and robotics, I think that'll even accelerate it. But just looking at the S&P 500's operating profit margin, we started 30 years ago at 6%, more than double now, over 12%, and looking forward as well, that's expected to accelerate. This year, approaching all-time highs, 14%. So in other words, it would actually be weird if valuations hadn't grown with corporate profitability as well. If this blue line was still the same level as it was 30 years ago, that would be very cheap. And don't get me wrong, I'm not saying the S&P 500 index itself is cheap here. We have been on a great run for 2 years. But the big difference from last time in the late 90s is these mega cap tech companies are just pumping out cash. They weren't really all that profitable at all back then. In fact, most of them were actually losing money. This time they're absolutely cash cows. Thanks to the explosive growth in cloud, now we've got AI. Could keep it going. No doubt we'll pull back to this line of regression at some point. But that regression line is uptrending over time. And again, what also comes into play is bond yields, which were actually higher back then as well. The gap between what you could earn in stocks and bonds was much more favorable for bonds in the late 90s. Screaming a buy signal actually. Now the forward earnings yield on even the S&P 500 index is about the same as a 10-year. So again, everything's relative. Don't just look at absolute stats, as you'll easily be misled. And just like 2022, when we saw a significant bump up in inflation, wasn't indeed transitory, absolutely smashed bonds. Inflation goes up, yields have to go up. New bonds that have been sold are worth more than old bonds with a lower coupon. That's what causes old bond prices to go down. They're less valued in the market compared to new bonds with a higher coupon. But that's also not good for stocks either. Cost of capital going up. Bond yields going up. Stocks typically have to pull back to remain attractive. That's why sometimes stocks and bonds are getting created. Commodities can be the best place to hide out. Even a little cash. It's an old saying in investing, buy bonds anytime you can get a yield above 6%. But countering that is the new government. Interesting to hear from Elon today say, as it becomes clear that DOGE is working, you will see the long-term treasury bill yields fall. And all Americans will benefit from lower interest payments on mortgages, small business debt, credit card, and other loans. And that's what I was saying yesterday. They're really cleaning up all this wasteful spending. He really thinks he can cut $2 trillion in US government spending. That's pretty much the deficit. Last year, they spent about $6.5 trillion, took in a bit over $2 trillion deficit. The US government does materially spend a lot less going forward over the next couple of years. They won't have to sell as many bonds to the market to make up for that shortfall from the tax revenue they pull in and what they spend. They simply just sell bonds to make up the shortfall. Now, less supply of treasuries and demand for them still stays there. In theory, that should bring yields down. Elon could very well be correct. Fed may not even have to move as much. A lot of banks, finance companies, a lot of them key off the 10-year yield, probably the most important asset in the world. That gets down into a 3 handle. Well, we've still got economic growth holding up. That's going to be great for stocks. And Trump is a busy man. Looking at the number of executive orders just in his first 10 days, he's already signed more than any other president did in their first 100. So things are moving at lightning pace here. It is hard to keep up with everything that's going on. Got a lot of moving parts. A lot of things are changing. And that's why you got to think about these things holistically. What's their mandate? What's their agenda? What do they want to get done? Instead of focusing on the bits and pieces and noise, just realize they're trying to really open up America, deregulate, lower taxes, really get behind businesses, get behind entrepreneurs, along with cultural changes, really clamping down on the surge of illegals coming into the country. How's that going to change the jobs market? Could actually lead to a lower US employment rate. And that's because even though hiring has slowed in the past year, the US is still creating more than enough jobs to absorb what's likely to be a smaller number of people entering the labor force. And that's probably already showing up in the latest print, unemployment going down to 4% actually. And so I expect to hear a lot more. This pace doesn't look to slow down anytime soon. Trump's talking about reciprocal tariffs come on Thursday, just before Indian Prime Minister Modi comes to meet him at the White House. Said he planned to slap reciprocal tariffs on every country that imposes import duties on the US. Again, if you just follow mainstream media, you would be led to believe he's gone off the rails and he's a tariff man, wanting to slap tariffs on everybody. But the reason why he's been outspoken about this for the last 40 years is because if you look at the actual data, the States actually has the lowest average tariff rates against all of its major trading partners versus what they place on US imports. That's right, India places on average 17% tariff on US goods coming into their country. South Korea 13.4%, China 7.5%, Brazil 11.2%, France, Italy, Ireland, Netherlands 5%, the US 3.3%. And that's why Trump's argued for a long time America's been treated unfairly. This is part of the reason America runs huge trade deficits, and he's just looking to bring that in line with the rest of the world, or otherwise get a deal done, which could actually result in other countries lowering their tariffs on US goods, which will help US exporters and balance out importers paying a bit more for some goods, which will create some pockets of isolated inflation in those product categories. But necessities, what people pay for rent, their electricity, a lot of local food, that's kind of all insulated from tariffs. It's more the stuff being manufactured, China, Vietnam, Taiwan, and others. And at the end of the day, don't get too caught up in all this tariffs. I don't think it's going to be enough to completely destroy the global financial system, like some people are claiming out there, because there are some other good things happening as well. Trump and Putin just actually spoke over the phone, in which it was reported went really well, and they're about to actually start peace talks on Ukraine. Geopolitical tensions look to be getting dialed down as promised. Europe under the previous leadership of Biden were just seeking to escalate it and send hundreds and hundreds of more American taxpayer money there. And just like we've seen in Afghanistan, they could drag that out for another 20 years as well. End up spending trillions of dollars, wasting thousands of lives, basically nothing. Took the country off the Taliban only to hand it right back to them, this time with a lot of leftover US weapons and assets. So no surprise to see crude oil pull back on that news today, but it could go even further than that. According to Bank of America, they think global oil demand is slowing and will peak by 2030 as the world slowly but surely transitions to green energy. Nuclear is going to play a big role in powering all these AI data centers. Wind and solar, already the dominant energy source in many markets around the world. The Saudis see it coming as well. That's why they offloaded their signature asset, Aramco, to global investors. And once again, we've got crude oil bumping around, $71 a barrel. So geopolitical tensions are dialing down. Still could have a showdown with Iran, but I don't think they're that stupid. And I don't think the market really cares about what's going on in the Gaza Strip. Surprisingly, gold still held up though, meaning it may not be trading so much on a geopolitical risk premium, which for sure hasn't completely gone away. It's just moving in the right direction. Gold is still staying bid here. Foreign central banks buying, maybe some inflation hedges, because long-term treasuries haven't been a good place to hide out for a long time now. Still looking a little stretched here in the short term, but it has been on a good run quite a while now. And we are starting to see some large gold miners potentially waking up in the market. Barrick Gold on the back of their good earnings today, 10% better than expected, even though revenue came in shy. Like I said, profitability is increasing, price of the underlying going up. Whilst crude is staying low, valuations are still good. Helping my recent trade in Newmont continue to do well, but not doing so well today was the Meet Kevin Pricing Power ETF. Ticker symbol PP. Had a monster gap down, finished down 1%, and appears to be coming off after hours as I speak as well. And for those of you who don't know, Meet Kevin is a popular financial YouTuber. Got over 2 million subscribers on YouTube. And it was reported yesterday that his ETF is going to close down. Later on this month, they're going to liquidate its portfolio and then it's going to be wrapped up. And that's probably why we've seen holders of the fund sell out today, causing it to fall even further than the market. And so let's just look at how the fund performed. We'll just go out to a weekly chart here, and I'll just drop all the indicators off. And so we can see it came onto the market in November 22. So it's a bit over 2 years old. Then we'll just overlay it with the performance of the S&P 500 during the same time period. Okay, so the S&P is up 48% and the PP ETF in the same time about 28%, which is almost half its performance. If it was 24 down here, that would be half the performance of the S&P. Was doing quite well there for a bit, getting carried away. However, according to Meet Kevin, he came across as being frustrated with the fund manager and said he lost a bunch of money, and those were largely his reasons for wanting to close it down. In my opinion, I don't think it's a coincidence that he's significantly underperformed the market over the last 6 months or so. He did mention the pressure to perform. And so again, in my opinion, I think he may have been worried of the impact on his reputation of significantly underperforming the market and what impact it could have on all his other products. Because it's interesting looking at his website, and if you watch his videos, he's always promoting his courses, which include his trade alerts. He gives out stock and option trade alerts as part of buying his products. However, I've looked all over his website and I can't seem to find any sort of track record. Does anybody know if Meet Kevin actually keeps a track record of all his trade and option alerts he gives out? Or is it just for entertainment? Because just looking across Reddit in the Meet Kevin subreddit, there's quite a few comments saying there isn't a track record and that sometimes he only talks about his winners on the show and doesn't mention all his losses, with some people saying they've actually lost a lot of money. So by the looks of it, he doesn't appear to have or keep any transparent track record of how the performance of his trade alerts do. But like I said, he's got over 2 million YouTube subscribers, obviously making millions of dollars selling products to everyone. And this isn't just Meet Kevin. Like I said, most financial YouTubers have all these membership products, trade alerts, but there's just no transparent track records. I think it should be a legal requirement. If you're going to offer a trade alert, stock picks, you should be trading them yourself and keeping a transparent track record for your members to see how you're performing. But anyway, I guess that's the industry. And at the end of the day, it seems to come down to who's best at making videos instead of who's best at trading. And so you might be thinking, well, who are you to question them, Jared? Do you keep a track record? Well, yes, I do for all my products. And just looking at my oldest product I started in June last year, did stumble out of the gates for a few months there until I built the portfolio out. I buy $500 in a new stock every Monday. But once I got a good portfolio together, it's been performing exceptionally well. In fact, looking at time weighted return since June last year, it's up 44% versus the S&P 500 up 12.6%. And just looking at simple return, if I'd been buying $500 every Monday of the S&P 500, say the SPY ETF, I'd be up 5.64%. But my stock picks portfolio is up 26%. And this is all 100% transparent. I tell all my members the stock I'm going to buy the day before I buy it, along with posting a screenshot from my brokerage account in the members area for, like I said, complete transparency. All my trades and numbers can be verified. And that's a look at the equity curve of my stock picks account. And the reason why it's so smooth is thanks to dollar cost averaging. Like I said, buying $500 of a new stock every Monday, trend following, cutting losses, running winners, and diversification. All the free lunches and investing I've combined together, and that makes for a much more psychologically easier ride when investing when your account looks like this. And I've still got available spots for anybody who wants to jump on board. I'm only allowing 500 members to join this service before I close it down, and we are quickly approaching that 139. I think they'll all be gone at some point this year, possibly in the next couple of months. So if you're interested in hopping on board, getting my deep dive research and reports in your inbox every Sunday, along with access to the private members area, head on over to my site, clickcapital.io, and jump on board today. And make sure you come back to this channel, Click Capital, tomorrow. I'll show you another really popular financial YouTuber who, in my opinion, is selling out his audience, doing some really dodgy stuff. And I'll show you proof of that tomorrow right here on the show. And so just be careful who you follow. They may not be who they appear to be. All right, just wrapping up today with a look at some hot stocks. One that popped up on my radar today, Structure. They're involved in AI. Big, massive buy the dip a few days ago. Appears to be bouncing back. Still got the nuclear trade lighting up. Look at Lightbridge. Wow, 34% today. There's BlackBerry still going on a march, coming back from nowhere a few months ago. Lucky Strike Entertainment. They operate bowling centers across the states, up 9.5% today. One of my favorite beverages, Heineken, trades over in Euronext, having a good pop on some pretty good earnings. They also trade in the States over the counter under the ticker symbol Heine. We also saw drugstore chain CVS have a pretty good pop on their earnings today. A lot better than expected, still making money. And retail drugstores been absolutely slammed the last couple of years, especially Walgreens. But we're getting some pretty fat green accumulation candles here. Didn't seem to get too excited on the back of CVS news today, but this company still has a lot of work to do to turn around and basically resize itself in the new modern digital economy. That's pretty much a wrap for today, guys. We got PPI coming tomorrow, retail sales on Friday. And like I said, even though the market did gap down today, it was a little bit of a dip buy, still finished a bit soft, a little bit of bearish breadth, but the fix is still quite tame, 15.8. And we do have bond yields reacting to that inflation data. If they continue to run, we may indeed see stocks continue to get softer. However, like I showed you with all those inflation data prints, we're still bumping around basing. We haven't really broken out to the upside on inflation just yet, but that for sure is going to be the worry of the market. However, looking at real-time data with Truflation, it's actually been trending down. So I'll be looking for a cooler print on CPI next month. Otherwise, if not, commodities will be the place to be, and not just gold either. Copper, uranium, and a few others, even though oil may continue to remain soft. That's all for now, and make sure you come back to this channel tomorrow. Got a good one coming. See you then, guys. Cheers.